Hey guys, Tyler Casey here from my porch in sunny Florida here in late December. Um, and I just, you know, uh, my wife Renee and I, and now our large team, have been pretty successful in scaling our property management company to we manage 2,000 rental properties now across 5 cities. Um, Renee and I also personally built a portfolio of 150 rental units ourselves. Uh, all of that started back when I was in college. I started by buying one house in 2008. Uh, I had about $1,500 in the bank and had about $30,000 in student loan debt. And the house needed renovations, and I actually went and got a Home Depot credit card, got the materials myself. Um, I recruited some of my buddies to help me do the renovations so I could, do it inexpensively. My dad helped me with some of the renovations. In fact, those guys kind of taught me some of how to do the renovation work through that process and the next, handful of properties that I purchased. Um, and I screwed everything up you possibly could on that deal. I overpaid for it in the first place, over invested in it. I had way more in it than what it was worth. Um, didn't catch some of the big items that would come up in preceding years of ownership. And, unfortunately, I learned a lot of things the hard way. I wasn't smart enough to try to learn from people who had already done it. And so that's what I'm going to try to do today is just for free give you the information that you need if you're thinking about going out and investing in real estate, that will help you avoid some of the pitfalls that I did. So there's two things that matter in real estate investing. Number one, how you buy and structure the deal. This means what do you pay for it versus what does it rent for versus what is the market value. Um, what is the plan? So does it require renovations? Does it require management improvements like improved lease up, like there's lots of vacancy, or um, way under market rents, things like that, operationally that you need to address. Um, how do you structure debt if you're using debt to finance your real estate investments? Because the debt structure can totally make or break a deal. And then the second part of it is how do you operate the deal? So if you're doing renovations, this includes efficiency of construction, uh, cost of construction, timeline of construction, carrying costs, which goes back into your deal structure. But then the big part of it is the ongoing management of the asset once it's done, stabilized, ready to rent. How good are you at leasing it? How good are you at vetting the tenants? How good are you at collecting rents? How good are you at doing maintenance that maintains the value of the property but doesn't overspend a maintenance budget projection? You really need to get all those things right for a real estate investment to be successful. So this is not, which is why I ended up over all these years, uh, building out a system that is, sort of works to do all those things. Which obviously you can't afford to build out the system that I've built out just to start real estate investing. But that's why we do construction in house. That's why we have third party property management firm. That's why we have the real estate brokerage for lead generation, deal flow. Um, and we've built, I say we, more my wife Renee has built systems and processes around all those operations things, so that our team can now execute on them. So when you're looking at a deal, there's a lot of different ways that you can make money. You can buy a deal, put 20% down, rent it out, make a little bit of, structure. If you have cash, you can do this. put a down payment down, structure the debt in a way that it produces a cash flow, and then you obviously expect over a long enough holding period to get some passive appreciation, right? Um, if you're starting like I did and you don't have cash, you can't really afford to do what I did, which is buy, a deal for maybe market value if you're lucky, and then fix it up, which puts you in it well above market value, and use debt for all of that. That's terrible, terrible way to do it. Not a good way to make money. Um, you really need to find, if you have no money to start or have little money to start, you really need to find a deal that is valued at less than what the total investment will be. So, if it doesn't require renovations, you need to buy it for somehow 20% less than what it's worth. That's hard to do. What's easier to do is if you find a deal that, say easier, it's not easier. There's plenty of pitfalls and ways you can screw this up too. But, if you find a deal that has problems, you find a property that has a really poor tenant pool in it that's just doing damages and not really paying their rent consistently and is maybe paying under market, and you can buy it for what it's worth kind of today as it sits, and you're the person who can solve all of those problems in your deal structure and then your execution, that is how you make a business out of real estate. That's not a passive investment. The only way, really, in my view, real estate investment works as a passive investment is if you start out with money or you hire a really good property management firm. Those are your only two options. And I would still say that doing it that way is semi-passive. The only way you can really invest in real estate passively is by investing in a fund or a REIT or, something like that. Any real estate investing you do, there's going to be some oversight. There's going to be some money moving, some strategy sessions with your team, even if it's an outsourced team. There's going to be some reporting to go over and things like that. So I think a lot of people have this view of real estate as like mailbox money, and it can be if you already have money and you're just investing it with somebody who's an operator that knows how to return the money to you, plus a rate of return. But if you're going to be directly purchasing the assets, directly managing that process, even if you're hiring a manager, this will be work. It will not be easy. It is a way to, you can build value into real estate that you can't really do in other assets. Like I can't control a public stock that I bought to the level that I change their operations, I increase their profitability, and I change the value of the stock. I can't do that. With a piece of real estate, I can sometimes go buy a house for $50,000, and I can put $30,000 into it, and now on the market it's worth 100. So I can sell it and I can make, 15 or 20 grand after you take fees into account. Or I can leverage against that. I can take debt against that asset up to 80%, which means that I could, essentially claim that $20,000 of equity that I created, with no cash out of pocket to do it. So it is the only asset class where the work can pay off, if you know how to do it, if you know how to structure the deals, if you have a plan to operate the deals. If not, maybe you ought to put money in your 401k.